With both investing and in life, it's challenging but super important to parse out the signal from the noise. So when I come across a signal, I broadcast it here on this channel, Unrivaled Investing. I previously did a video warning investors about the ARK ETFs in February 2021, suggesting that there was huge downside based on the commentary from Michael Burry, famous investor who also called The Big Short. Since that video, the ARK ETFs have seen about a 60-70% drawdown during that time. And so I think the more recent signal, the data point that investors really should understand, investors in all types of risk assets should appreciate, is the recent speech by Federal Reserve Chair Jerome Powell on restoring price stability. I think it will have huge repercussions for investors around the world in the months ahead. So the gist of the speech is that inflation is just too darn high. It's currently, shy of 10%, and there's a good chance it goes much higher in the months ahead, partly in response to the invasion of the Ukraine by Russia and the associated complete disaster supply chain impacts and huge surge in commodity prices. And so what do you see the Federal Reserve doing? You see, first of all, them recognizing that they're going to own this. They're going to say, look, what will it take to restore price stability? The ultimate responsibility for price stability rests with the Federal Reserve. This is important ownership here. We will take the necessary steps to ensure a return to price stability. In particular, if we conclude that it is appropriate to move more aggressively by raising the federal funds rate by more than 25 basis points, so a quarter of a point, at a meeting or meetings, we will do so. And if we determine that we will need to tighten beyond common measures of neutral and into a more restrictive stance, we will do that as well. This is a really important data point. This is effectively saying, hey, we're more comfortable hiking and moving faster looking at this inflation. We're not going to tolerate this high inflation for much longer. That's at least the signaling that we're seeing. If this is your first time tuning in, by the way, my name is Daniel. You're watching Unrivaled Investing. This is a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. So this is a really important change in tone by Jerome Powell, Federal Reserve Chair, saying, look, we are going to be aggressive and we will do seriously, about tackling this inflation. We will own this, going forward. We effectively, the responsibility for price stability rests with the Federal Reserve. Now, this does, cause investors to worry. Could this lead to a recession? Could this lead to a stock market crash? And the reason why you see this type of, concern from Federal Reserve tightening is that the economy runs on credit. Credit is the biggest component that drives the economy, or one of the biggest components. And so as you see rates go higher, it does sort of clog the gears a bit of the economy. It makes it harder to transact. Very basic model. If you think about mortgage rates moving up, it becomes harder to afford a home. So therefore, you start seeing home prices start taking a tick. And that, is just one example, but you see that over and over again. As credit costs move up, it hinders the economy. And that's the concern is, will the Federal Reserve, in an attempt to get inflation under control, put the economy in a recession, potentially causing a stock market crash, because you typically see that when there's a recession. And so it's important to understand that while right now you may not be seeing data points suggesting that there's a recession if you look at risk assets, but the reality is the bond market is saying, yes, there's a big red flag here. You look at, let's say, the 3-year Treasury yield versus the 10-year Treasury yield, and you're looking at a bond market saying, yeah, there's a problem here because you can get more from a 3-year bond versus a 10-year bond in terms of the yield. This typically implies, and you see inversions like this, the 3-year, 10-year, or 2-year, 10-year, 2-year, 5-year. You see these types of inversions happen, oftentimes preceding before a recession, months before, because it's in anticipation that sometime in the future you might have to lower rates actually in response to economic weakness. And so this is the concern, that will the Federal Reserve tighten in response to inflation and ultimately cause the economy to crater and cause the stock market to crater as well. So once again, Jerome Powell directly addresses this. So how likely is that monetary policy can lower inflation without causing a recession? So this is sort of like the Goldilocks scenario. Some have argued that history stacks the odds against achieving a soft landing and point to the 1994 episode as the only successful soft landing in the post-war period. I believe that the historical record provides some grounds for optimism. Soft, or at least soft-ish landings have been relatively common in U.S. monetary history. Talks about 3 episodes in 1965, 1984, and 1994, where the Fed raised the Fed funds rate significantly in response to perceived overheating without precipitating a recession. So here it is, once again, Jerome Powell saying, look, we got this under control. We will tackle inflation. And if you look at these 3 prior periods, 1965, 1984, and 1994, the Fed did not cause an ensuing recession. You won't see that stock market collapse. Don't worry. Now, I'm not a super duper scholar on macroeconomics like Jerome Powell is, but you know who is Lawrence Summers, former Treasury Secretary, and he calls out, look, it's nice to sort of have this happy talk, but the reality is these alleged soft landings, were from nothing like current inflation and labor tightness. They were explicitly preemptive, something the current Fed explicitly rejected in its 2020 operating procedures. So really, he's saying, look, this isn't going to happen, folks. This is a very different economic setup. You're much more likely to see that sort of economic recession in response to this. And you've also seen similar commentary, with Ray Dalio saying, similar take. Now, so far, what's my take on what's happening and what could potentially happen in the months and years ahead? So first of all, since that speech, you've seen a huge risk-on rally, particularly with equities jumping, but you also see it with some cryptocurrencies jumping. I think the cryptocurrencies are a good reflection of sort of investor behavior of saying, hey, risk on, let's just move into leverage assets. You look at equities certainly have had a nice rally, up several percent since Jerome Powell's initial speech, effectively raising rates. But the question is, how long does it last? And so my view is, looking at this, there's a few data points that one needs to consider, is that it takes time for these interest rate hikes to sort of permeate throughout the economy before you really start seeing that slowdown in terms of underlying economic activity. So you're going to see these quarter point hikes. You're going to see half percentage hikes potentially in the future. And you're going to see quantitative tightening as the Federal Reserve unwinds their $9 trillion balance sheet. I think all these different data points will ultimately result in a weakening economy. And so the question is, once again, how long does that take? It's not going to be overnight. And I think that's part of the reason why you're seeing this bid up in risk assets. Hey, things are good now. They got it under control. No recession in sight. Let's keep partying. But the reality is, I think at some point in weeks or months, you will start seeing that economic hit. You're not quite there right now, but as you look at this risk, this risk on rally with stock prices, I think I'm personally, as I consider it, I'm looking at this and thinking, what do I want to lighten up on, in the days, weeks ahead, because you're getting this rally and what I suspect will be a recession caused by the Federal Reserve in response to very high inflation. They have to do this. They own this. They effectively saying, look, we need to own price stability. And so if they do not own price stability in the quarters ahead, that's ultimately going to be Jerome Powell's job on the line. So he's acknowledging that, and the trade-off ultimately is likely to be the economy. When the economy's in recession, typically stock prices really do come down significantly because you see underlying results decline. And when the underlying results decline, people say, hey, this stock should get an even lower valuation multiple. So you get this double whammy hit. It's sort of like the reverse of what people saw during, the COVID rally, where, people bid up on these work from home stocks. Oh, these have great fundamentals. Let's assume a higher valuation. It's the exact inverse of that. As companies report worse results, they assume an even worse valuation. It's sort of like a double whammy. And so I think it's very possible you see that in the months, years ahead. It is a big concern. The risk of this has moved a lot higher. You're seeing that with the bond market. So I'm personally looking at this thinking it's important to consider lightening up, considering, what positions I want to own that are riskier. What are the position sizing for that? And also, what do I own that are, let's say, the necessities of businesses? For example, let's consider the full risk spectrum for different assets. If you have, let's say, a discretionary medical product, that could come under could come under heat if it's a discretionary purchase. Whereas if you have something that's a required medical product, I'd feel more confident about that, because it's sort of saying, hey, this is something that people need for their health. That's just, thinking about one range of, scenario. Another is, thinking about something like insurance. Companies will need insurance. If you have inflation, insurance companies will continue to say, hey, you know what? The premium's going up this year. So you have organic growth for these companies. So I'm like, for my insurance investments, I'd say, hey, I'd continue holding this because they could benefit from an inflationary environment. So looking at these different dynamics, I think it's important to size up what is sort of the risk spectrum of what you own. How sensitive is it to risk on, risk off? If you have a risk off period, how likely is it that these assets decline significantly? How sensitive are they to the economy? And I think there is a much higher chance that you do see economic contraction in the months and quarters ahead. And certainly it's possible that it's further driven by the Federal Reserve, not only by sort of economic shock from what you're seeing with commodity spikes, but also in response to the Federal Reserve saying, hey, this is price stability. I think this is a really important signal versus the noise. You're constantly inundated with YouTube videos, data points, news articles. I think this is a really important data point, really important signal for investors to consider in the weeks and months ahead. If this video has been helpful for you, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for tuning in.